Broadcasting from the 72nd floor of First Canadian Place in the heart of Toronto's financial district, this is #Finance, the podcast that profiles innovative entrepreneurs and thought leaders operating in the public markets. Presented to you by the CSE, the Exchange for Entrepreneurs.
Hi, it's Phil from the CSE. We're here today with Mo Lidsky. He is CEO of Prime Quadrant, one of Canada's larger money managers. How are you?
I'm great. Thank you for having me.
Yeah, it's been a pleasure. We first met, I guess, through your Prime Quadrant Conference. This would have been somewhere around 6 months ago. We were engaged with working with you to get your annual conference up and running. But why don't you tell us a bit about what Prime Quadrant is, who you are, tell us a bit about your background, how'd you get into your space, and we'll go from there.
Sure. So Prime Quadrant is Canada's largest multifamily office, an investment research and consulting firm. So we advise ultra-high net worth families and single-family offices across all asset classes and all geographies, and we do that on an unbiased, conflict-free basis. So totally open architecture, and again, across all asset classes, we sort of function as the outsourced chief investment officer for some of the largest families in the country. In terms of how I got into this space, my own background is I've been an owner-operator. I've run, built, grown businesses and organizations. And when I myself came into some liquidity, and on a relative basis, substantial liquidity, I did the fairly traditional things, investing with traditional brokers or advisors or wealth managers. And what I realized going through the crisis and having eviscerated a very significant amount of my own net worth, and I was really by virtue of my own silliness and folly and just ignorance in terms of how to actually manage money at the time. But by going through that process and again eviscerating a significant amount of my net worth, walking away from a significant amount of real estate, and being in a very tough, painful environment, I sort of realized there's got to be a better way. And at that point in time, started looking around for somebody that could manage my own money in a way that's differentiated, in a way that's conflict-free, in a way that reaches beyond traditional capital markets and into things like private equity and real assets and infrastructure credit, various uncorrelated hedge strategies, venture, et cetera, et cetera. And what quickly dawned on me was that the overwhelming majority of the financial industry is some variation of, we gather assets and that's how we make money, or we transact with assets and that's how we make money, and that's all fine and good. Mm-hmm. But what falls in the crevices of those two buckets is just unbiased, conflict-free advice, irrespective of whether somebody makes an investment decision, to what extent and where. And so really went on a journey to identify somebody who's actually providing that, couldn't find it, and decided, why not partner up with a friend of mine that was running a single family office and had a concept that was aligned with this thinking. And from there, it was just the two of us, and we built Prime Quadrant today. Today, we work with about 120 families in Canada. They're across Canada. We have some families in Europe and the U.S., the Middle East, and South America as well, but predominantly Canada. We advise on somewhere in the order of $15 billion, and the team here. We have an office in Calgary, but right now the bulk of the team is here in Toronto, and we're about 35 some people here.
That's a good amount of money that you're managing. $15 billion is definitely right, as you would say, in the Prime Quadrant.
Well, and I should clarify, again, we're consultants, right? So we're agnostic. We don't get paid on the assets, and our compensation isn't driven by it. So we consult on that quantum, but it doesn't in any way impact our top line or bottom line.
Yeah, sure. So if you were to look at 2019 as an investing year, tell me about how you think the market has done relative to what you thought, and then kind of transition that to where you think 2020 is going to be, and what are some of the hot spots that people should be looking for in 2020?
So the market has done surprisingly well. I think, by my own admission, I would not have positioned us to be here or projected us being here in early 2019. I'm not, and nor is anybody on my team, in the business of prognosticating or forecasting. And we sort of set our asset allocations to be somewhat timeless. Yeah, there's, of course, adjustments and tactical reallocations, but I think that our job isn't to guess where the S&P will be tomorrow or a year from now. Having said that, I do believe that there were a lot of things that came into play which didn't anticipate about a year and change ago, which would be continuing, first of all, lowering of rates, the fact that Trump and China would normalize or sort of settle down, and some of the trade concerns, were relaxed. And I think that the market as a whole ticking along. I don't know what the chicken or the egg was. I don't know what the cause and effect is, but all I could say is the market has done better than we anticipated, for sure.
Definitely.
I think we position ourselves to be super protective in 2018, leading into 2019. We're still positioning ourselves to be super protective, notwithstanding the fact the market has risen. And I think we're in a unique period of time where, over the next 6 to 12 months, the market could rise another 15 to 20%, or the market could fall 15 to 20%. And everybody will say, yeah, I could have saw that coming. Whereas you didn't have that same sentiment, a year ago, where people were a little bit more bullish, a little more bearish and concerned. So, having said that, I think we are positioned as protective because debt levels are still at all-time highs, and the cost of carry is a massive overhang. Most economies aren't raising rates, which suggests, or at least not in any expedient manner, which suggests that there is still, the fundamentals are still weak. Consumption is nowhere near where one would expect. GDP growth, although again a little higher than expected this past year, still not what one would imagine. And again, I think the prospect of rising rates and what that will do to the debt burdens, that will play out in the economy. And so, and all of that is on top of the fact that we are in the, most robust, longest recovery in history. Put it all together, it doesn't generally suggest that we're going to have another 3 to 5 years of healthy returns, but who the hell knows? At the end of the day, anything's possible, but we are positioning ourselves extremely protectively, trying to manage risk as efficiently as possible, keeping powder dry to some extent. And
I love that term, keeping powder dry.
Yeah,
I say that all the time.
Yeah, but that's what we're trying to do. I mean, it's when you think about some of the best performing asset classes generally. Think about private equity or even various forms of value-add real assets. Those investments that were made in those asset classes in the 2005-2006 period, those vintages did fairly poorly, over simply because when they were investing, and then when they were divesting, was kind of in the aftermath of the crisis. And so I don't know if we're in one of those vintages. It certainly feels that way, but one can't really know for sure.
So in preparation for this interview, I did a bit of research about the company, and I noticed there's a ton of educational stuff on your website. And so I wanted to ask you, so if I'm a retail investor give me 5 things that me as a retail investor, because of course you manage ultra high net worth money, and it's theoretically there's slightly different opportunities which are available for that group of investors versus regular retail people. Retail being defined as the average individual who will invest in some stocks here, some real estate there, but don't have that large amount of disposable income. So give me 3 things that one should watch out for when investing, and 3 things that they should be doing.
Wow, tall order. So I'm going to plead ignorance on a couple fronts, simply because we don't work with most retail investors. And again, we primarily focus on the ultra high net worth segment. My perspective will be somewhat limited.
Sure.
But I would say common principles and common best practices. So number 1 is, again, I think this is motherhood and apple pie, but manage your exposures through thoughtful diversification. And I think really what's missed with a lot of retail investors is just because things are called different things doesn't mean they have different exposures. So it's really understanding what is driving this investment. Is it interest rates? Is it credit? Is it equity markets? Is it some kind of a trading strategy? What's the risk that I'm taking? Is it real estate? Whatever. And if I look at my portfolio as a whole, are those exposures quite different? Because the irony of it is, it may sound a little strange, but one would want to be exposed to as many different risks as possible. So that's that. And I think one common mistake with a lot of retail investors is they have a portfolio that has a lot of stuff, a lot of names, even lots of names of different funds and income this and value that, but ultimately little diversification from an exposure point of view. So that's number 1.
Okay.
Number 2, I would say thinking about things. Another common mistake I find is people approach things reactively versus proactively. So, if people are operating a business, they would never, in the context of their business, buy a mission-critical piece of software or technology by responding to the first person that shows up at their door with a flyer. That just wouldn't happen. Maybe that's how you buy your pizza or your takeout or something, but you don't make significant capital allocation decisions that way. Yet, when it comes to investments, people tend to simply react to the things that come their way from their friends, their neighbors, whatever, and don't proactively figure out what is truly best in class. How does this stack relative to benchmarks? How does it stack relative to peer groups? And what are my next best alternatives? So I think those are always fundamentals. Those are always fundamental best practices. In terms of I would say, again, this is cliche, but watching the costs, watching the fees, making sure that there's actual value being created by whatever
Good point. Yep. Good point.
whatever fees are actually spent. I think it's naive to say that the lowest fee products are always going to be better. Like, that's just simply not the case. And when you look across the asset classes, there's a fair bit of divergence, but there should be some thoughtfulness about, am I paying for value creation? Is what I'm paying competitive relative to what the market offers? So those are, I think, generally things that retail investors should be thinking about.
Okay.
I think we could come back to other things as we go, but those are just top of mind.
Sometimes I find that, like, when I'm talking to individuals about what mutual fund that they're actually going to buy, is that they'll look at past performance, and that thinking that that's a good way and a segue for me to decide which one to pick, because you think that it's hit 15% over the last year, it's going to continue to hit 15. Of course, it's a fallacy, right? So
yeah, for sure. I mean, it's a fallacy. What behavioral economists would refer to that as the recency bias. Is we tend to respond more to the things that are more recent than actually looking at things over a sufficiently long period of time.
Right.
And I think that's actually true. And I'm going to come back to your point about performance track, recent performance and performance in general. But I think when we think about things like fixed income, and you think about the fact that it is an anchor in every single retail investor's portfolio today, part of the reason that's the case is because for the last 38, 39 years, it has been the go-to safe asset. And part of the reason that it's been the go-to safe asset, it's not because it's senior in the capital structure, which is a part of it, but primarily because interest rates for the last 38 years have been coming down. So from 1981 till today, I mean, you're talking about interest rates coming down from the teens, from the high teens, all the way down to flat. And that has translated into fixed income returns that are in the order of about 7% annualized, which is effectively the long-term historic returns on equities. And what I think is lost in that is, well, wait a second. Well, what happens when the tide shifts? What happens when we have the opposite response? So what happened in the 30 years leading up to 1981 as interest rates from the late 40s or even early 50s were starting to rise? So if you look from 1954 to 1981, as interest rates were coming up, and they came up pretty high, fixed income was actually losing 2% a year. So somebody starts out with $1,000 in the 1950s. They invested in what's ostensibly safe bonds that are being some kind of portfolio of bonds that are being traded. And all of a sudden, by 1981, that's worth $600. That's nominal. In real dollars, it's worth about $250. And after you factor in transaction costs and taxes, you're actually below $200. So $1,000 that's worth $200 30 years later is certainly not a safe asset. But that's kind of how we've been positioning fixed income, and that's why it's so central to all the portfolios. So I think that's a perfect example of an extended recency bias, and that's why everybody was this, well, I'll just pour in more bonds, especially long duration bonds, and then hope for the best. The next 20 to 30 years don't seem like they will bode well for that if we actually have a similar experience to 1954 to 1981.
Well, very intriguing stuff. Again, in the research, in preparation for this, I know that you are an author, and you've written 4 books, I understand, right? Selling Snake Oil, The Philanthropic Mind, In Search of Prime Quadrant, and Partners in Preservation. So I have bought one of your books, Selling Snake Oil, and
I'm sorry.
and I've read a few passages out of this, and I wanted to see if you would sign this for me.
I'll sign it for you, but it depreciates the value in the open market the second I do that. All right. Well, I'll be happy to do so. Wow. All right. Well, first of all, thank you. I appreciate the honor.
It is my honor. Thank you very much. Now, as we kind of go through this, talking about some of the books, I wanted to have you kind of highlight what the inspiration for this book is and what you're trying to achieve out of this. There are kind of like 6 factors that you've talked about: third-party verification, checks and balances, compliance and regulation, quality of people, validity of opportunity, and consistency and alignment. But kind of tell me about this book and what are you trying to achieve with this book?
Sure. So Selling Snake Oil was a 7-year project. It wasn't intended to be. I thought it would be a 6-month project. But effectively in the early days of running Prime Quadrant, I came into a situation where I was almost a victim of a fraud. And the shocking thing, now, thankfully, we didn't get to first base with the opportunity, but I didn't quite see the fraud. And my partner at the time felt it in his bones. He literally kicked the fellow out of our office. And I thought my partner had lost his marbles. What are you getting worked up about?
Right.
But he actually felt it in his gut that this thing was a scam. And what concerned me was that here I was consulting to and advising ultra high net worth families about manager selection, making better investment decisions, portfolio construction, et cetera, et cetera. And here I myself was vulnerable. And I thought to myself, well, a doctor or a pediatrician should detect a basic cold on site, and here I am, and I just simply missed it. And so the initial motivation was simply to research some of the most, as many of the prominent and innovative financial frauds that were ever executed. And I spent the next, call it 4 to 6 months, immersed reading every fraud book that was out there on the market. And I realized a couple of things. So firstly, most of the books that were out there on the market dealt with primarily corporate frauds. Mm-hmm. And, think of Enron, think of WorldCom, think of Sunbeam. I mean, these were corporate frauds and where publicly traded stocks, certainly investors had them in their portfolios, but they would have been one of many securities. Very few investors, and I mean private investors, would have actually done any diligence on these companies other than being recommended by a broker or money manager or whatever else. And even the brokers or money managers, if they had done due diligence, a lot of these frauds got past the auditors, which, Arthur Andersen is kind of one of the more dramatic examples, but some of the other more prominent auditors. And if it got past the auditors, it certainly got past the analysts. So I think the prospect of protecting people from those kinds of corporate frauds was low and unlikely. And furthermore, given the demographic with which we work, which is ultra high net worth families and family offices, a much higher concentration of their net worth will be invested in direct deals, in various limited partnerships. Much less of it will be in traditional equities or individual securities of that sort. So I looked for books that actually spoke to this demographic and dealt with those kinds of frauds. Couldn't really find them. So I then proceeded to chronicle the 400 to 500 of the most innovative frauds that were executed in private markets, and then subsequently distilled those down to the 50 cases that I thought were most salient for Salacious and salient for readers and salacious for somebody who would be picking up the book just to keep them engaged. And so the book is now effectively that. It's a compilation of 50 cases or so. And I think what I was trying to achieve is create a shortcut for somebody who's not fluent in the world of financial frauds, somebody who's not even necessarily fluent in financial markets, but to give them through those factors that you've outlined and the various red flags associated with them, almost like a checklist that they could go through on any opportunity. And while nothing is perfect, and this checklist certainly wouldn't be, I think anybody that has gone through the book and then uses it as a resource should be able to eliminate 90 to 95% of the frauds that come their way.
Yeah, I found it was a very easy read, and you've done a lot of research based off history. So you've got cases, I think, a few decades old.
Even a few centuries.
And it's even a few centuries old, yeah. And it was like, wow, that makes like total sense. I think it's available on Amazon, so I would highly recommend to go buy this book.
Thank you. And by the way, all proceeds from the book, 100% of it goes into our foundation, so it's going to be distributable into local healthcare causes.
Okay, great. That's a good segue to your Prime Quadrant Conference, which I know that you hold annually.
Yep.
Tell us a bit about that and what that's used for as well.
Sure. So I think from the early days, again, bearing in mind the group of the kind of families we work with, which are ultra high net worth families, and who are typically investing directly with operators or managers. So going all the way back to our earliest days, we would often invite the various managers or operators or partners to come to our offices and have our families meet with them and get acquainted with them. As the number of families that we work with grew, that became more and more difficult to just put people around a boardroom table.
Sure.
So we started to have, smaller events. And my partner and I were involved with Mount Sinai at the time, and the president of the foundation approached us going back 9 years and said, listen, you guys are generous donors to the hospital, but perhaps you could leverage the network that you have, which are some of the most prominent and most successful and wealthiest families locally, to help us raise money for the hospital. And I said, well, what did you have in mind? And he said, well, maybe doing an event with all your people. And so at the time, I was trying to figure out what could we do to get more people exposed to some of the thinkers and asset managers and sort of financial thought leaders that we were bringing on a regular basis. And so we experimented with doing the conference thinking, this could be phenomenal leverage. It will cost us, instead of making a $50,000 donation to the hospital, we could spend $50,000 in the event, ask all of the families to contribute, invite 100 families, and voila, we just had a great event. We turned $50,000 into $100,000 for the cause, and did a fantastic event for our families.
That's great.
So that's kind of how it started. It grew very quickly. The subsequent year went from 100 families to 200 families, then went to 300 families. And now, and for the last, I would say 4 years, we cut it off at 400 families. So it's once a year, November next year. The next one is November 5th, 2020. And we invite top financial minds from around the world to come in, have our families interact with them, and all the families make a meaningful gift to be there.
That's great.
We're raising right now, trying to finish a raise for the Medical Psychiatry Alliance, which is a partnership between Sick Kids, CAMH, Trillium, and University of Toronto Faculty of Medicine to bring the worlds of mental health and physical health together, particularly in pediatrics for children. And again, I think that like year one, 100% of the proceeds, 100% of
That's wonderful.
fees, go straight to the cause. And we and a couple of sponsors, as you guys generously have been this past year, really cover all the costs and make it the tremendous event that it has become. Thankfully, it is now the largest family office conference in the country, and we don't plan on expanding it, but hope to continue doing it for many years to come.
Approximately how much was raised in 2019?
So we're still adding it up. I think we're at about $500,000.
Oh wow,
and
that's awesome!
We're
Congratulations.
But we still have a lot of the gifts who are coming in,
Yeah.
So we're hoping to far exceed that.
Yeah. On that note, we're going to wrap this up, but tell us about how someone can keep abreast of Prime Quadrant, and how do people get a hold of you?
How do people get a hold of me? To be honest, I'm trying to make sure less people get a hold of me now. But I have 5 kids at home that are constantly trying to figure out how to get a hold of me, and my wife is 6th in line, which I pay the price for. So, but if people wanted to get acquainted with Prime Quadrant, they could certainly go on www.primequadrant.com. I believe, my team tells me, there's a whole social media presence, which I'm not exactly familiar with, but I'm told it's there, and be delighted to connect with anybody that thinks our worlds may intersect. So
okay, well, thank you very much. Once again, it's Phillip here for #Finance. I'm here with Mo Lidsky, CEO of Prime Quadrant. Thank you very much for your time. We very much appreciate this, and best of luck.
Thank you. Thanks a lot, Phil.
Thanks.
We're social here at the CSE. Each and every day we'll keep you up to date on trending topics that investors are talking about, such as cannabis, blockchain, and esports. Follow daily CSE news and events on your favorite social media platform: Twitter, Instagram, Facebook, LinkedIn, and YouTube. You'll find exclusive interviews with leading entrepreneurs from a variety of industries, thought-provoking stories from across the world of finance, and updates from CSE events taking place worldwide. Join the conversation and connect with us today.